All right, hey YouTube, Invest with Blev back again. If you don't know, I'm Andy. I've got this channel that we basically talk all about different investing and trading situations. And my goal is to help beginner and intermediate investors and traders just get better so that we can all grow and learn together. So today's topic is going to be a little different. I'm going to speak generally about real estate investment trusts and specifically about RioCan, which is a specific REIT or real estate investment trust. So in this video, I'm going to go over what an REIT is. I'm going to go over RioCan specifically, talk about why it's so beat down right now from a stock price standpoint, and what you can expect if you buy RioCan. And I'll give my buy, don't buy opinion at the end of this video. Remember, I'm not a professional investor or advisor, so these are all my opinions. Let's get to it. Okay, so first, what is a real estate investment trust, or REIT? I'm just going to say REIT because there's way too many words. So in general, a REIT is basically a company that has focused on buying, managing, and creating income from real estate. So very commonly when you're looking at a REIT, it is either holding commercial property or residential property or rental property or a mix of all these. And the objective is that those managers, the people that run that company, are creating income from rent that's paid to them by companies or individuals that own these places. So that rent and income comes into the company. They, pay everybody they need to pay. They run their operations, and then any profit that comes out of that then gets provided back to shareholders in the form of a very regular and dependable dividend. So in a nutshell, that's what a real estate investment trust or REIT is. So you might ask yourself, why would somebody buy a REIT versus just buying stock in a normal company like Visa or Microsoft or Apple? So there's really two main reasons that people would buy a REIT. Reason number one is that they really want to get into real estate investing without the hassle of owning actual real estate. So let's say you have some money set aside and you'd like to get into real estate. If you want to actually buy a second home or an apartment or anything that you want to actually rent out to create income, you have to have enough money to put down. You have to go through the mortgage process, the lending process. You have to, understand any legal elements to it. And then once you've actually bought a piece of property, you have to manage tenants and renters, which takes effort. I mean, I've done it in the past, and if I was renting a lot of properties at once, it is a lot of work. So that's one thing that is difficult. And, people may just say, look, I don't want to have to deal with all that trouble. I just want to invest in real estate without owning the real estate. An REIT gives you that ability. The second reason that people buy an REIT versus a normal stock is just because of the regular dividends. If you are what we call an income investor or a dividend investor, you're always on the hunt for companies that are going to provide a regular dividend with low risk, and an REIT does exactly that. So all that income that comes in from their rental agreements, anything that's profit, it depends on the country that the REIT is in, but up to 90% of that profit must be dispersed amongst all the shareholders. So that's going to give you a good regular dividend that you can always depend on, always count on. And that is the second main reason that people buy an REIT. Okay, so let's talk about RioCan specifically. So RioCan, I'm calling it RioCan because that's the easiest stock ticker, but the actual name is RioCan Real Estate Investment Trust. So this is the second largest REIT in Canada. And if I take a look at this specific example of a REIT, I think it's a great example. It gives you a good overview of exactly what it's like to own one of these investment instruments. So the first thing I notice about RioCan is that the stock price itself, the actual cost to buy, is incredibly steady. If you look here first at the 5-year run, I mean, all the way back to 2015, all the way up to just before COVID hit, it's basically been the same price, very little change, but same dividend as well. They give a very good dividend, and they haven't skipped a dividend in 20 years. Now, what happened is, you can see, let's go to the 1-year chart from Seeking Alpha, you can see obviously as soon as COVID hit, this thing just got smashed, and from a stock price standpoint, it came all the way down to the low teens. So it's down 46% approximately this year in price. But remember, they haven't cut their dividend in 20 years. When people buy an REIT, really you're not buying it because you want the share price to go up. You're buying it for that income, because in reality, it's very rare for people to actually have a big gain on a share price of an REIT. So what you'll often see is the price to book value, meaning how expensive is the company in relation to its overall book value, ends up being somewhat low on REITs. And it can look like, wow, this is an amazing buy. I should own this because it's got a very low price to book value. And I will say, with RioCan, it is low. It's low even in relationship to its competitors, other REITs. Now, I will say also that when I look at RioCan, for a long time, the market really has not put a high value on this stock. It's always had a relatively low price to book value. And I really can't say why. I mean, I've done research, and it appears that this management team is good. They know what they're doing. They have a very good portfolio that they own of different types of properties. They've done a good job of de-risking their portfolio of properties to try to be recession-proof. Nothing can really be COVID-proof. I mean, who could ever predict that? So it's been undervalued by the market prior to COVID. It still is. And there is something great about that, because I think, just looking at where this thing has been and where it is now, that if you bought it right now, you could really expect this to go to $20 a share with a high degree of certainty. Nothing is a sure bet, but this thing should be at $20 or more per share, especially as traffic comes back into the Canadian marketplace and things begin to open up more and more. This thing is going to go back to its pre-COVID numbers, and just briefly, its pre-COVID numbers were really right around $20 a share. So I think if you bought now, you're going to get your dividends. You also have a likelihood of getting about a 25% increase in your share value, which is great. That's definitely nothing to ignore. After it goes up to $20 or so, it probably will level off again and stay there unless something significant has changed in the marketplace. So one question is, what other things like RioCan are out there? I mean, obviously there's a lot of REITs that are available. I did a little bit of research, and if you like the idea of a REIT that has a high dividend and a relatively low price to book value, there's one other, and it's called GEO, and that's GEO. Now, the one thing about this one that made me a little uncomfortable is that it's basically, GEO is basically real estate. Its real estate is focused on prisons, mental health facilities, and other public service facilities in the United States. So if you have any issues with owning that, then this will probably be one you steer away from. But the government is the actual payer. So this is not a company that is owning property that private renters or commercial organizations are renting. The government is renting. So it's a very dependable revenue. So it's less risky. And they pay a very high dividend. It's 11% plus, which is pretty high. In some cases, it's almost double what RioCan is providing. The price to book is not as good as RioCan. And I'll say this, with RioCan right now, you probably will get a significant capital appreciation, which is just another way of saying your actual share price will increase, not just your dividend payouts. The actual share price will increase. With GEO, you're going to get a higher dividend, but I'm not sure that you're going to get the same type of share price increase you would get if you bought RioCan right now. So your share price isn't going to go up.
Hey guys, you might wonder where all this information came from with regards to all the research that I'm talking about that I did. If you watch my video, how did I beat the market? Definitely not by day trading. I make recommendations of a few sites, so Seeking Alpha, Yahoo Finance, StockTwits, a few others, and really that's what I did to get this data on RioCan and some of the data on REITs in general. So have a look at that video. It'll help you learn how to basically do all the research that I did for this video.
Okay, so to summarize, If you are a dividend investor and you're looking for a solid income, low risk REIT, then RioCan is really a good buy all the way up to $20 a share. So right now is honestly a good time to double down and just keep buying it if you own it already. Now, are there higher dividends out there? Yes, there are. We talked about one that's Geo, but I will say that the mix of a good dividend and a good price to book value is pretty unique with RioCan. Now, if you're looking for a faster appreciation of your capital, meaning that you want your capital to grow at a faster rate with maybe some higher risk, then there are better buys out there for sure. They're not REITs, but it is higher risk. RioCan is a good solid play if you want dividends and you want low risk and you want to be able to count on it. But I will say this, one quick tip that may not be clear to everybody: when you're getting when you're getting dividends paid out to you from a real estate investment trust, those are not taxed like normal capital gains are. They are taxed at your normal income rate. So for example, if you are paying 35% tax on your own income, your dividend payouts from an REIT will be taxed at that same rate. They will not be taxed at that lower capital gains rate. So don't be surprised by that. The best way to avoid that is if you're planning on buying and holding these for a long time, hold them in a tax-free way. So I know in Canada, there's a tax-free model you can do. In the United States, we call it a Roth IRA. So just something to watch out for. Don't get surprised by the taxes you end up having to pay on the fund distributions. The last point I will make before we close out is that it's important to remember what your goals are from a growth standpoint. For me personally, as you know, if you've checked out some of the initial videos on my channel, my goal is to beat the S&P 500 every year. Now, the average growth the S&P has had is 10% per year, if you look over the last 30 years. So my view is if I can't beat that 10% number, then I should stop doing active investing. I should buy SPY, the ETF that tracks the SPY. I should buy it and just call it a day because I'm going to do better just owning the SPY. And so my goal is always to beat that 10% number and beat it significantly as much as I can. So I would probably not, in my own investing portfolio, buy an REIT unless it is going to for sure be beating that number each year, which is really the reason that I am not going to buy RioCan right now. Now, the flip side of that argument is that RioCan is low in its price to book value right now. It really should be at $20 a share, if not higher. So if you bought RioCan right now, you probably would get a good appreciation in addition to your dividend. But that 25% is kind of the ceiling from what I can see. I would rather find something that's got a 50% or higher opportunity for growth in this in the next 12 to 18 months. Those are the things that I target.
I have to say that I really agree with what Chris Investing says in his video, that having friends that are investing that you can talk with, you can share things with, compare notes, is incredibly important. As a matter of fact, I've seen a really big increase in my own results, really starting about, 3 months ago when a friend of mine and I started talking every day about the things we were seeing, what we were buying, what we were selling, the reasoning behind what we were investing in. So I definitely I'm gonna do a video on that topic in the future. But if you watch my video about my own results, it's called "Did I Really Beat the Market?" You'll see that really just after COVID initially hit is when I started to see some even better results than I had in the past, and a lot of that has to do with finding friends that are investing. So Chris, absolutely true in that point, and let's keep growing this community. Thanks everybody.